If we're right on what's going to happen here, that debasement trade is going to be wrong, because the dollar is going to go up perhaps more dramatically than anyone expects. And all other things equal, that alone would drive the gold price down. Institutions started learning more about Bitcoin. They learned about this 4-year cycle. And so my guess is there are a lot of institutions that have held back and are saying, let me wait until the dust settles and around this 4-year cycle, and I'll pick my spots.
Cathie Wood begins with cycle analysis. Bitcoin's recent drawdown, approximately 50% from peak, has been painful. Yet in historical perspective, it is not extraordinary. The earliest major cycle saw Bitcoin fall roughly 95%. The last cycle experienced a decline closer to 75%. By comparison, the current correction, while significant, is milder. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
In terms of where we are in the cycle, well, because we didn't have the kind of soaring upcycle after the halving, we did not expect this much of a correction. It's still not as bad. It's about a 50% correction. It's still not as bad as we have seen in the past, which was in the beginning down 95%, and I think the last cycle was down 75%. So maybe we've bottomed. I don't know. It's uncanny, this 4-year cycle, but we do have to wonder how much of this has been caused by the flash crash on October 10th, which many people have wondered if I've been saying this correctly. We had the flash crash. Binance didn't cause it at all. There was excessive leverage, but Binance exacerbated what happened in terms of the deleveraging because of a software glitch that it had, and caused a lot of auto deleveraging. So I think that unnerved many people, and they're waiting to see still if there is a whale out there who's going to be forced to sell Bitcoin because he or she is so underwater and receiving margin calls from prime brokers. We heard recently that that is indeed what has happened. That was a rumor. And if that is what has happened, then I feel we're pretty close to the bottom. But famous last words, you don't know if that rumored whale did go down, because if it's a whale, we should know about it. The green light that regulators gave Bitcoin and the ETFs here in the United States, yes, was the beginning of institutional investment. But as institutions started learning more about Bitcoin, they learned about this 4-year cycle. And so my guess is there are a lot of institutions that have held back and are saying, let me wait until the dust settles and around this 4-year cycle, and I'll pick my spots. But they know they have a fiduciary responsibility. Advisors do, asset allocators do, because Bitcoin is not correlated to any other asset class.
And gold?
Well, it's interesting. Bitcoin, if you look since late 2019 to today, the correlation between gold and Bitcoin has been 0.14, hardly any correlation whatsoever. But if you zoom out a bit, you can see the last 2 cycles were led by gold, not by Bitcoin. So we shall see. One of the most fascinating charts I've seen recently is the market cap of gold to M2. Now, we use US M2 because we can get those data back into the early 1900s. So if you look at that chart, gold hit an all-time high 2 weeks ago relative to M2. There have been only 2 times that we're even close to it. One was at the end of the 70s, early 80s, when inflation here in the United States was raging at a double-digit rate. And so that was understandable, but that was the peak. And then gold went down for 20 years. The price went down for 20 years. And then the other peak was, I believe it was 1934, the Great Depression. And what was happening then was a deflationary bust. Money supply was collapsing. So the denominator pushed it up dramatically because the gold price was fixed back then. So that was a deflationary bust, and which defined the Great Depression. We're not anywhere near that. So that's how extreme gold has become. And so I would say, if I were a betting person, and I am, as an investor, we have to, these are not bets without being backed up by research, but I would say the gold price has peaked. Again, famous last words. If something goes wrong in Iran, I could be very wrong. But absent that, I really do think the gold price has peaked. If we're right on what's going to happen here, that debasement trade is going to be wrong, because the dollar is going to go up perhaps more dramatically than anyone expects. And all other things equal, that alone would drive the gold price down. And I think this end of U.S. exceptionalism concept being fed by the dollar's recent decline misses this point that all of the policy actions in the last year are so positive for United States assets that I think the head fake is going to be the dollar going up as more foreign direct investment heads here and as more capital after this rotation comes back.
Inflation remains the central macro battleground. Wood references real-time inflation tracking through measures such as Truflation, which aggregates thousands of price points continuously. According to that metric, inflation peaked near 12% in 2022 and has since fallen below 1%. Official government measures tend to lag such real-time data. If they follow the same trajectory, inflation could fall well below 2% this year.
So we're putting a paper out, I would say, in the next couple of weeks about quantum. In Big Ideas, you can see a kind of a preliminary thought. In Big Ideas, and in a section called The Great Acceleration by Brett Winton, our chief futurist, we show the progress in quantum that Google, which is at the bleeding edge of quantum computing, that Google has made. And it has doubled the most important metric in terms of gauging, are we ready for prime time? It has doubled the number of qubits in the last 4 years. That is slower than Moore's law scaling, right? And if it continues at that pace, and typically technologies do continue at the pace, at which they start, then quantum computing is not going to be commercially viable until 2064. If somehow Google speeds this up to Moore's law, so twice as fast the progress, then we're talking 2045, I think, something around that time. Now, that doesn't mean, we should dismiss the quantum as a threat. We need to take any new technology seriously, or any new technology that in my career, practically since, I'm going to say for the last 25 years, quantum has always been 20 years away, right? So here again, we're saying 20-ish years away. Nonetheless, we shouldn't dismiss it, and We do know that half of the solution to a problem is understanding the problem. And we're learning, okay, if you make a change in these OG wallets, to an updated wallet, that will be quantum resistant. So I think that's very healthy for the ecosystem to anticipate this. We are not worried about quantum in the short term, and that will be the gist of the paper that we're putting out in the next few weeks. Kevin Warsh is a hawk, so he tends to be very disciplined in terms of monetary policy. So I think some people are saying, wait a minute, he's going to be tougher than Powell. Be careful. I actually think the stars are aligning perfectly for him. Because if you look at inflation measures in real time, there's a measure called Truflation. It measures in real time 10,000 items 24/7. And that measure of inflation peaked at 12% in 22, and it is now below 1%. And the traditional measures of inflation, or the government measures of inflation, tend to follow this measure of inflation. So I think inflation is going to break down well below 2% this year, and according to the official measures. And I also think real growth will accelerate, with productivity a very important part of the real growth acceleration. The most potent anti-inflationary force out there is productivity. And so I do believe, now consider the source, I've been saying this for a while, not understanding that the supply shock from COVID was going to last 3 years, and not understanding that President Trump would do another round of tariff increases, bigger, in his second term. But so I've been saying what I'm about to say now for the last year. We think that that prices will move into negative territory in the next few years. So the burden of proof is on us, but I'm happy that Truflation has dropped below 1%. We believe that that we're climbing a wall of worry in the stock market, and the strongest bull markets I've experienced in my 40-year-plus career have been climbing a wall of worry, particularly in the 80s and 90s. And I feel that we're going back to that kind of period. The market is hitting all-time highs, and we've gotten through so much turmoil in the last year, especially the tariff turmoil, which I know has hit every country and seems as chaotic to us as it does to you, as well as our government shutdown and the continuation of the Japanese yen carry trade unwind. That continues. And yet the market is hitting highs. Now, on the AI hype, is this hype? We do not believe so. We believe we're in the middle of or at the beginning, I should actually say, at the beginning of the most powerful technology revolution in history. And the reason people are fearful is because the people and the investors, the analysts who were around for the tech and telecom bubble in the late 90s, they are now the most senior people in the industry. They're the gray hairs now, and the elder statesmen, and many of them are saying, and this is because they don't do the kind of technology research around which we have centered our research and investing, but they remember there's a lot of scar tissue from back then. And now that they're so senior in the industry, we hear many of them say, been there, done that, not going to do that again. I think if you look at our research, and we just put out Big Ideas 2026 in January, you will see how early we believe we are in this technology cycle. And as you said in your introduction, It's not just AI, but it's AI speeding up all of the other innovation platforms: robotics, energy storage, blockchain technology, and multiomics technology. So we believe that the investment cycle in most sectors around these innovations has really, it's closer to the beginning than it is to the middle even.
Cathie Wood's macro vision blends humility about short-term unpredictability with conviction about long-term direction. Bitcoin's correction may be nearing completion. Institutional capital remains methodical but interested. Gold appears historically stretched relative to money supply.